Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, I tell.
All right. Hey guys, my name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And you are in the right place. Sit back, settle in. This is going to be an awesome show. We had a lot of data released this week, mainly the CPI numbers. And what did that do to the market? Wow. It knocked the legs. It was like one of those America's Funny videos when the dog's leash gets wrapped around the owner's leg, and then it takes off chasing the cat, and then boom, the owner goes down. The stock market dropped like a rock, was down over 700 points for quite some time and closed down around, 525. And the credit markets did the same thing. Interest rates bounced up, and it was an ugly, ugly reaction to a hotter than expected inflation number. And guys, I'm hoping that this gets everybody's attention and we start paying attention to the people that are worth paying attention to when it comes to policy decisions around interest rates. Because everybody dancing up and down TikTok and Instagram and Facebook and all the social media platforms are calling for rate cut, rate cut, rate cut, rate cut. And the Fed has been very, very firm in their stance, saying that's not going to happen anytime soon, and not until we see a significant sign that we are approaching 2%. And this CPI number did nothing but solidify their position that it's not time to cut rates. Not to mention that when we're talking about mortgages, the Federal Reserve does not control mortgage interest rates. And the clearest way I can demonstrate that is the first week in January of 23 and the first week in January of 24, the mortgage rates were about the same, yet the Fed funds rate was 1 full percentage point lower. So there's no logical explanation for that if you truly believe the Fed controls mortgage rates. So anyway, I'm not going to beat that drum. I talk about that all the time. If you have questions, we can talk about it. But this week was a clear indicator that there's more work on the inflation front. And guys, cooling inflation doesn't mean lowering prices. And I know that the headlines are doing their very best to make us feel good about the economy. And they showed us that eggs were down 28% year over year. However, we climbed to such high prices for everything that any pullback doesn't get us back where we were. And the Fed said that in that 60 Minutes interview a couple weeks ago. And if you didn't watch that interview, I encourage everybody, go to YouTube and Google Jerome Powell 60 Minutes interview. It's worth the watch. He's very, very understandable and very, very clear. And I'm not a fan, guys. You know, I've been super critical of Chairman Powell over the years, especially around that inflation is transitory period of time where I really think they fell flat on their face. That's part of the reason why we're here today. However, if there's anybody that you need to pay attention to, he's very clear and has a track record of doing what he says he's going to do, even if it's something that he shouldn't be doing in the case of leaving rates as low as they were for as long as they were. So check that interview out. But he basically said, guys, slowing inflation doesn't mean prices are going to come back down. There are a lot of prices on a lot of goods and services that are never going to come back down. So if you're waiting for this big market correction across the board for everything to suddenly, the clouds to part and the sun to come out and the birds to start sing again, and we've got $1.99 gas and we've got, $4.99 ground beef or whatever your correlation is to the good old days, that's not going to happen. We just have to adjust to where we are. And real estate is one of those things. I'm hearing people all the time talking about how the market's going to crash, the market's going to crash. Guys, interest rates haven't crashed the market. If anything was going to crash the market, it was going to be the affordability. And it didn't trip anything. Guys, the only thing that's going to push prices down is oversupply. And yes, inventory numbers are coming up, but they're still lower than pre-pandemic numbers. And the absorption rate, meaning demand to supply, is still quite healthy. So until that tips into an oversupply, it doesn't matter what the cost of money is. And we're not there yet. And we may never get there. And a lot of people who are rooting for this crash, like they're going to become this opportunistic buyer. What is your life going to look like if the economy crashes? What is your job going to look like? Are you going to be in the position to go in there and scoop this up? And who's not to say the BlackRocks of the world and all of these Wall Street investors aren't just sitting on the side waiting for that to happen so they could buy. And they're going to buy every incremental step down. They're going to cost average their way down, while you, as that one person, is going to be waiting on that all-time low. You're going to miss it. You're not going to have an opportunity. The big guys are going to cost average down and absorb any big inventory push. The one thing giving a little bit of hope to that argument that there might be some inventory coming in the foreclosure world, and we've disputed that several times over the last couple of years because the foreclosure numbers aren't up significantly compared to normal. Compared to pandemic numbers, yes, one is double what it was the month before during the pandemic. But we are seeing an increase in delinquencies in FHA loans. So I do want to pay attention to that. That number is up to 10.8%, which really, really surprised me because conventional loans, I think they were 2.6%, and VA loans were somewhere in the very low fours. So for FHA to be all the way up near 11% of the active FHA loans in this country with the delinquency really, really surprised me. Now, that doesn't mean they're going into foreclosure. That it just simply means one or more payments were late, delinquent. It doesn't mean that they're in default, but it is the precursor to default, which is the precursor to a foreclosure. Now, in this equity-rich market that we're in, it's unlikely that somebody's going to hold it all the way to foreclosure, but you don't know. We saw people in the real estate crash, 08 to 2010, if you will. I try not to remember those dates. I still have post-traumatic stress disorder over that period of time in this industry. But there were people who just put their head in the sand and just, let that equity blow away over time instead of cashing out, taking as much as they could and going and rebuilding their life. But with all that being said, I always want to talk about both sides of the data, and we are seeing an uptick in FHA mortgage delinquencies nationwide. So we're going to watch that carefully and see what that does to supply. At the moment, there's no indication that it's going to push us into an oversupply. We're still in an inventory environment with enough demand to absorb the inventory. And that's even at these rates. And guys, when we say even at these rates, before the CPI numbers came out, people were receiving rate quotes of about 6.75, 6.875. After the CPI number hit and we had that quote unquote bloodbath, if you will, right? The market closed down, over 500 points, and interest rates were up over 7. I just want to do this comparison. A $300,000 loan at 6.875% has a principal and interest payment of $1,971. 1971, $300,000 at 6.875. At 7.125, that same $300,000 costs $2,021. That is a $50 increase. And I say it all the time when you're watching rate. If a $50 increase suddenly makes your decision no longer viable, you're way, way, way too close to the edge. You have no business doing. You're not ready. You're not ready in this market because next year's taxes, next year's homeowners insurance adjustment is going to send you into a tailspin. So if $50 pushes you out of the market, which is what the equivalent is of that rate hike, you got no business being in the market. And I don't mean that to sound like a jackass. I'm just being honest. There's other costs to consider. And that $50 will get eaten up in a hurry by those other costs. So anyway, I just wanted to throw that out there, guys. Hey, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very, very short break. We'll be back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
We're back. Hey guys, Mark Eitel here, and this is the Mr. Mortgage Show. Thanks for hanging in there with us through that break. We are going to dive into your questions. I'm super excited to get to your questions. Looking forward to what everybody is thinking and wondering about this week. Hey, if you have questions or comments and you want them on the air, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime hotline. And Jen is womanning the hotline, and she'll get your questions on the air. Wow, I still have a little bit of last night's karaoke in my voice. Hey, if you don't want to shoot your questions over via text and you don't want to give us a call, you can head over to MrMortgageRadio.com. That's MrMortgageRadio.com. And right in the middle of the screen, you can't miss it, big orange button that says Get Your Questions on the Air. If you click that button, follow the instructions, Jen will get your question and read it for you on the air. Guys, I'm super excited to dive in. I think we kicked a bit of an ant pile with that opening monologue, if you will, because we've already got some questions in. So let me throw it over to Jen and let's get this party started.
Sophia sent us this. I follow some people on TikTok who keep saying prices will crash this summer, especially in Florida. I've heard the other side of the argument too, so I'm confused. What do you think? I just want to make a smart decision.
Hey, Sophia, I feel for you. It is super, super confusing. I mean, I see those same TikTokers. I'm not afraid to admit it. I do enjoy scrolling through TikTok from time to time. And I think I know who you're talking about. But here's my take on it all. It's all supply and demand. I say it all the time. There's really no other way around it. And until there are more sellers than buyers, there's no way values are going to go down. And I say that because interest rates didn't push values down when they went from 3 to over 8%. Guys, think about that. If you look historically, how long it's taken for a rate to go from 3 double to 6, and then here we go, another 33% to 8 in the course of what, a year? That's nuts. It put no downward pressure on values as a whole. The market slowed down, absolutely, but it slowed down primarily because sellers didn't want to get rid of that 3% interest rate. And who can blame them? And that's what's happening now. There are people who normally would have sold by now who refinanced 2 years ago and are laughing all the way to the bank thinking, I'm just going to sit tight. Matter of fact, I was talking to a friend of mine who runs a very successful general contracting firm, and they do very high-end remodels and smaller commercial projects. And they're seeing an uptick in significant high-end remodels. And by that, I mean adding a master wing on the property, or putting in a swimming pool and a mother-in-law suite in the back. Not a, $40,000 renovation, but a $700,000 full-blown addition and remodel. So it's interesting. I'm watching to see what happens, right? We called it nesting last time. When people couldn't sell their homes, they ended up investing in things like outdoor furnishings and renovations because they felt stuck in their home and they wanted to make it nice. Well, they're not stuck in their home this time. They're choosing not to sell because of that low rate, but they've got a ton of equity. And we see it. People are using equity lines and equity loans to pull some capital out for renovations. So when you talk about the TikTokers and what do I think is going to happen, I don't have a crystal ball. But I don't see anything lining up that has crash, flashing over the top of it. I don't see pending doom in our near-term future. I think the overall interest rate picture is going to soften a bit. And every time rates pull back, we have an uptick in demand, and that absorbs that supply. It's happened several times throughout this increasing rate cycle. Every time we pull back a little, somebody capitalizes on it. So I would watch days on market And days on market is a term for how long a property stays on the market before it goes under contract. That's the important part. Sometimes it takes, 2 weeks to close a property. Sometimes it takes 2 months. I would be less concerned about that. But how long it takes between the for sale sign and the contract. Watch the days on market. And if they start to tick up significantly, then maybe we're approaching a leveling period, or we might see a slight downturn. But until we're oversupplied, I don't think there's a big downside risk to a property crash if that's your fear for jumping in now and buying a home. So that's just my take. And man, watch TikTok, but don't buy into too much of it. I see so much on TikTok. There's a lot of great advice on all social media for that matter. I'm picking on TikTok, but it is quite amazing at how that algorithm feeds you more and more of what you watch. But I've seen some horrible advice on TikTok, horrible advice that should not have a platform, that somebody's going to get hurt following. And I've seen loan programs completely misrepresented on TikTok, and I don't understand the purpose of it. I really don't, because at some point they're going to figure out that it's not going to work the way they're pitching it or selling it. So anyway, fundamental principles. Supply and demand control price. Affordability should control your decision-making process when it comes to buying a home. I know people who bought at the peak of the peak of the peak in 2005. And I'm thinking of a couple right now that bounces into my head. When the market crashed, the same house in their neighborhood, identical, it sold for less than half of what they paid. And they were distraught. We wasted all this money. Well, I talked to them a few years ago, maybe 2 or 3 years ago. It's probably been that long since we talked. They had stayed there. They loved the neighborhood. It was all the things it was before the market crashed. It was right where they wanted to be, right school zones, close to all the shopping. My point is they stayed, they paid, and it's worth double now than what they paid for it. I hope that helps. I know your question was about a crystal ball and what we see in the future, and I just don't have one, guys. I don't have one. I know prices have gotten to a point that it's so frustrating that part of the people are rooting for a crash. But if you're rooting for a crash, what are you really rooting for? Because what is the economy going to look like if the market crashes? I know a lot of people, when the market crashed, who were suddenly broke as a joke and had no opportunity to capitalize on all of these quote-unquote deals. Be careful what you wish for. Is the better plan to buy what you can afford, build some equity, and move up as quickly as possible? Play the latter game, right? Cash your equity in, get a bigger house, payment stays the same. Cash your equity in, bigger down payment, nicer house, better location, payment stays about the same. You're riding the equity ladder up. Is that the better move than just to root for the end of the world economically? I don't know. I don't have a crystal ball. But I love this conversation, and I really appreciate that question. Clearly, I like that conversation because I was a rambling. Hey, guys, you hear the music? You know what that means? It is time for me to stop talking. That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right. Hey, guys, we're back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. If you have questions or comments and you want them on the air, just call or text 855-462-7292. That's 855-462-7292, affectionately known as the Anytime Hotline. If you prefer, you can just head over to MrMortgageRadio.com. That's MrMortgageRadio.com. And right in the middle of the page is a big orange button. Click that button, follow the instructions, and Jen will get your questions over here in the studio, and she'll read them on the air for you. But hey, I know we've got a little backlog going back there. So let me throw it Jen's way right now and get to some more questions.
Victor has this question. Why is the interest rate higher if I choose not to escrow my taxes and insurance? I'm putting 20% down and have good credit. It seems like they're forcing me to escrow.
Hey, Victor, this is a great question, my man. And I know it's super, super frustrating. So it's risk-based. And I know you're probably one of those super fiscally responsible borrowers. You probably don't want to escrow because your money's earning interest somewhere else, and you'd rather it sit in that account until the end of the year than put it in the bank's escrow account on your behalf. Here's the thing. The only two things that can supersede a mortgage in the event of foreclosure are taxes, right? Or municipal liens, but primarily taxes. So if the taxes go unpaid and you're forced into a tax foreclosure auction, the mortgage is behind that. So there's a risk associated with you being responsible for saving the money throughout the year for your tax payment. So that's why they prefer to hold that for you. And then secondly, God forbid there's a natural disaster or a fire is probably a better example, and the house burns to the ground and you hadn't renewed the insurance and there's no insurance, there's no asset for them to sell at foreclosure auction. So it's purely risk-based. It's not credit risk-based. You meet the credit profile of an elite borrower, but it's a risk profile because they're depending on someone else other than themselves to pay the taxes and the insurance. And that's the simple truth, my man. I know it's frustrating, but it's a risk-based decision. I hope that helps. I know it doesn't make it any easier. Hey, Jen, throw me another question.
Here's one from Ron. Do you offer a no-income verification HELOC? We tried our bank, but our 2023 income was way down and we're not qualifying.
Ooh, this is a tough one, my man. There are no income verification HELOCs. Now, you may qualify for a rec refi if the debts that you wanted to pay off with the equity line can be paid off with the refi. If that is indeed what you're trying to accomplish, you may just be looking for, in case of emergency break glass money, then the rec refi is not going to help you accomplish that. But for somebody who's been denied an equity line and their goal of the equity line was to pay off debt, the rec refi is always a good option to consider because those debts that you want to pay off can be taken out of your debt to income ratio now. So a lower income can qualify for a rec refi than that same borrower qualifying for a HELOC because a HELOC is treated as new debt, additional debt. So I'm not sure where your strategy is around the HELOC, but a rec refi may be one place to look. And then if there's just a difficult time documenting income altogether, there are bank statement loans that might help with a refinance, and then asset-based loans. If you had a lot of assets in some other places, then there are some asset-based loans. One is asset depletion, is an income calculation strategy that could work. I'm not saying it will, but those are some other options. But those are refinance options, not equity lines. And I tell people this all the time. If you think you're going to jump out of the plane, have the parachute now. And what I mean by that is if you think troubled times are coming, get the equity line now. In most cases, it doesn't cost anything or very little if you get it from your bank, and you don't pay unless you use it. So if you're seeing a downtrend in your income, or you're fearing something on the horizon that might be an unforeseen expense, get the parachute now, because just like Ron is in this position where he's waited until his income's down. And Ron, I'm not suggesting that you waited on purpose. Don't mistake what I'm saying, but it's hard to do it now that you're in this position. So great question, my man. There are some strategies around debt consolidation that might help, but not a straight equity line. But I welcome you to call off the air. I'd love to discuss your circumstance with you and see if we can't map out a plan. Hey, Jen, throw me another question.
Geraldine sent this question. Our home has been paid off for years, so it's been a long time since I've talked about mortgages. How long is the process typically for a reverse mortgage? Approximately how much of our equity can we access? Thank you. I love your show, especially Jen. Aw, thank you, Geraldine.
Hey, that was well said, Geraldine. Yes, especially Jen. Jen is definitely the glue that holds this place together, the one that steers the boat right down the middle of the channel for us each week. I couldn't do it without you. I know I don't say it enough, but I appreciate you, just like Geraldine. So thanks for that one, Geraldine. But to answer your question, if you're looking from start to finish, there is a counseling segment of it. There's some additional disclosures. I would say about 45 days, 60 on the outside. The reality is you could do it in 30, but everything's got to be clicking. You got to have all your documentation together, be ready for that counseling session. Sometimes it takes a week or two to get an appointment for the counseling session, and that could push things back a little bit. And then as far as the amount of equity, it really depends on your age and how much equity is in the property. And I hesitate to even throw a number out there, but it's usually somewhere between 40 to 60% of the value of the property minus any liens is usually about where the amount of accessible equity lands. Now, the older you are, the higher that number is going to be. The younger you are, the lower that number is going to be. So there's a lot to discuss in working out the actual numbers, but that kind of gives you a bit of a rule of thumb, if you will. So great question, and I hope that helps. Hey, Jen, do you have another one back there?
Maya emailed this one. I'm a first-time buyer and have a 5% down payment saved. I know I'll need mortgage insurance, but how do I shop for it? Do I get it through my normal agent?
Hey, Maya, great question. Doesn't get asked often enough, and I know a lot of people think the same thing. No, mortgage insurance will be arranged through your lender. Whoever you're getting your mortgage through, whether it's a broker or a bank, there's only a few mortgage insurance companies, and each lender has approved companies, and it's not a program that you're shopping for like car insurance or homeowners insurance. It's tied to the mortgage, and the premium amount is based on your loan to value and your credit score and some other criteria. So it's built right into the mortgage and taken care of for you by whoever is originating your loan. Hey, and congratulations on being a first-time home buyer. Well done. And I know it gets super confusing, especially around insurance, right? There's homeowners insurance, there's title insurance, there's private mortgage insurance. There's a lot of insurance. You are well insured. Hey, I hope that helped. If you need more information, just reach out when we're not on the air. I'll be happy to answer any questions that you have. Guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And friends, we are super excited that you chose to spend a bit of your day with us. We've had a lot of fun so far and look forward to more questions and comments. We'll get to those in a minute, but if you want yours on the air, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime hotline. And Jen is womanning the hotline, and she will get your questions on the air. If you prefer to do it online, just head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Right in the middle of the page is a big orange button that says Get Your Questions on the Air. Just click that button, follow the instructions, and Jen will read your questions on the air for you. Hey, but speaking of Jen reading questions, I'm going to throw it to her right now for more questions. Hey, Jen, go ahead.
Janice has this question. We are making an offer on a house that had an unpermitted bathroom addition completed in 2018. The seller tells us it was done by a licensed contractor and up to code. It looks really nice. Is there anything we should be cautious of in this situation? Oh, yes.
Oh, yes, indeed. You know exactly where I'm going with this. This is a challenge, right? If it was done by a licensed contractor, all to code, why wasn't it permitted? Can it not be permitted? If that's the case, then it's not to code. So I always struggle with these because if you're just talking about finishing a garage or a basement, that's not a big deal. But if you're talking about adding living space, or in this case, a bathroom, right? There's plumbing, there's electrical, that's a significant renovation or addition in this case. As far as things to be aware of, are you going to run into problems down the road getting it permitted? Because somebody's going to have to go through the permitting process, and getting a permit after the fact often involves paying penalties and fines. And what are they going to want to do to inspect it? Are they going to want to remove the drywall, to look at the plumbing? So all of these are to be considered. From the mortgage standpoint, when the appraiser goes out to assign a value to the property, they're going to look at the tax rolls, and let's say they pull up a 3-bedroom, 2-bath property. And now, according to this addition, the property's really a 3-3 or a 4-3. You're buying a 4-bedroom, 3-bath house, right? Because of this addition, or at least a 3-bedroom, 3-bath house. But he can't assign a value to that bathroom because it doesn't exist. It's not on the tax rolls. That property, as far as everybody is concerned in the municipality, is a 3-bedroom, 2-bath property. So buying it with the additional bathroom might appeal to you, but I don't know how the appraiser is going to assign value to unpermitted renovations when it comes to adding living space. The two things that jump out at me are, what is the permitting process after the fact? And I would call the building department and ask them these questions. What is the penalty? What is the inspection process? Do you have to get engineered drawings for this work? And then the second problem that would jump out at me, or concern I would have, is, are you paying for that, right? And if you are paying for it, it's unlikely that the appraiser is going to be able to give you the value for it because, again, it was not permitted. So great question. It pops up all the time. You know, someone will convert a basement or enclose a garage or take a freestanding property in the back and turn it into a mother-in-law suite. We see that a lot. Somebody will have a, CBS structure that's essentially a garage or a storage building, and now it's a 1-bedroom apartment, but it was never permitted. So great question. I hope that helps. If you need to talk it through, just give me a call and we'll see if we can't figure something out. But those are the questions that I would ask the building department if it was me. Hey, Jen, throw me another one.
Michael sent this. Okay, I'm in a spot. I need to do a cash-out refinance to pay off my ex-wife and get her off the deed. The main issue is that the divorce was ugly and lasted 2 years. During that time, she did not pay the mortgage even though I gave her money. The last 13 months have been paid on time since I'm paying it. All of my other loans have been paid on time. I just have a bunch of mortgage lates. Somehow my score is 645. Is there any hope?
Wow, this is a really, really good question. So I need to look at the credit report to see exactly how many mortgage lates and how late. But the fact that you've been paying it on time for the last 13 months is super, super helpful. Now, one of the challenges that you may bump into is, you said, a cash out refinance, which is how 99% of the mortgage population out there is going to approach this. You're going to refinance the house, pull cash out, and pay your ex-wife off with the cash. The cash out refinance process, the underwriting process, there's a little more scrutiny. So my question would be, is there enough equity if they reduce the LTV because of the mortgage lates in a quote-unquote cash-out scenario? Now, I'm probably going to mispronounce this. It's been a long time since I've talked about this. but there's a lien called an ALTI lien. I'd love to talk to you off the air about this, but if you can get the attorneys to file an ALTI lien, that's her share of the equity as a lien on the property, then it's not a cash out refinance. That changes things. So that might give you what you need to get over the hump. You've got some things going for you, my man. You've got a good credit score in consideration of the mortgage rates. You've got a great story, and this is not unusual. Usually one party is unhappy that they're going through the divorce, and sadly, you put her in control of making that mortgage payment, and it's come back to bite you, and likely she didn't pay it on time knowing that it was going to come back to bite you. And I've seen this, him against her as well as her against him. What I've seen happen in the other scenario is suddenly she gets back in shape. She's in the gym. She starts to date the trainer. He gets upset, so he stops paying the bills to tank both their credit, thinking he's going to limit her from going out and buying another place and moving on and just kind of trap her in the relationship. So it's not uncommon in this scenario that one side or the other will purposely tank each other's credit. But the ALTI lien and treating it not as a cash out refi, but as a rate in term refi to satisfy that lien might help you get over the hump. I would like to look at the credit to see how many mortgage lates and how late they were to make sure that we're all on the same page. But man, great question. I hope that helps somebody out there. Guys, if anybody is going through this and you have questions about it, feel free to reach out. It's a very, very little known strategy, but it can make a big difference. So I appreciate that question. Hey, Jen, throw me another one.
Dana sent us this. We found a great house and we really want it. My agent says we should offer $10,000 over the price to get the offer accepted. What happens with the mortgage? Is it based on the higher price?
Oh man, I hate this so much. I really was hoping all of this was behind us. I hate the fact that we're paying more than something is even being offered for sale at or going to appraise. So how it works is the loan amount is always based on the purchase price or the appraisal, whichever is less. So if the house doesn't appraise for $10,000 over, that is likely going to be coming out of your pocket. So just know that going into it. And man, I wish I could find that very first person back in 2020 who had this brilliant idea to just give more than the seller wants. Let's just throw everything at it. Let's, you know what, waive our inspections. Let's waive our appraisal. I'll pay more than it's worth. I hate that as a strategy to buy a home. It's crazy to me. And just know that the loan amount is always based on the appraisal or the purchase price, whichever's less. So great question. Good luck with that one. Check in with me. I'd love to know how it works out. If you need help on the mortgage side and you haven't found a good broker yet, guys, let me throw that out there too. If you can hear my voice, we could be your choice. My team is nationwide, everywhere but New York, and we'd love to help if you need us. Oh, wow, you hear the music? You know what that means? No, it's not my cue. We've wrapped up another week here at the Mr. Mortgage Show. Man, time truly does fly when you sit me back here behind the microphone. Guys, I hope you had as much fun as we did. If you need us when we're not on the air, head over to MrMortgageRadio.com. That's MrMortgageRadio.com. One more time, MrMortgageRadio.com. Otherwise, Jen and I will be back next week right here. Same time, same station. Guys, have an awesome week. We're here if you need us.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.